Welcome to this video where we're covering asset deals and share deals, the two fundamental ways to sell a business. While the concept is quite simple on the surface, the implications, especially regarding taxes and deal mechanics, are quite significant, so understanding this is crucial for both buyers and sellers alike. When you sell a business, you can do it in two ways. Number one is a share deal, where you sell your ownership in the legal entity that holds that business. Or number two, an asset deal, where the company itself is not sold, only the assets that are related to the business. That means in an asset deal, the seller still owns the company after the transaction. Simple example, you own 100% of an LLC that runs a software business. In a share deal, you sell your ownership in that LLC, and in an asset deal, you would list out all the assets that are related to that software business, all the IP, agreements, and all those assets are sold by the LLC in one package to the buyer. Now let's compare these two options in terms of complexity. When it comes to transferring the assets, asset deals are worse because you have to define what the assets are and they have to be transferred one by one to the buyer. Also, agreements need to be reassigned because the employees and the freelancers will not be working for your company anymore. They will be working for the buyer's company. A share deal is much simpler in this regard. Since the company is sold, everything that's within it is sold as well, so there is no need to transfer out any assets. So after the deal has closed, share deals are simpler because you don't have to transfer the individual assets. However, this is counterbalanced by the fact that there is a lot more work to be done in a share deal before signing the papers. Why? Because in a share deal, the buyer acquires your company and with it, all the liabilities of that company. If taxes were not paid properly, if there are lawsuits, all that risk and liability is assumed by the buyer. Because of this, the due diligence phase is much more complex in a share deal because buyers have to conduct legal and financial due diligence on top of the normal business due diligence that they would be doing in an asset deal. To summarize, there is more work involved in share deals before signing the papers because buyers have to conduct very thorough due diligence. And in asset deals, there is more work after signing the papers because all those assets need to be transferred and all those contracts need to be reassigned. Yet buyers often prefer asset deals, especially in international transactions and especially in niches like software. Why? Well, first, the assets can be transferred quite easily. And second, the buyers often don't want or need another legal entity. Imagine a buyer from the United States looking to acquire a French software business. If they do a share deal, they would acquire the French legal entity, which means they have to start paying taxes in France and adhere to local laws and regulations. This can be quite a complex and daunting task, especially if you're not familiar with that country's legal system or language. However, buyers sometimes prefer a share deal exactly because of this, because they want to have legal presence in that country or in that continent, and it's much simpler to acquire the company itself than to set up a new company and then transfer all the assets. So depending on what the buyer wants, an asset or a share deal can make just as much sense. Now let's consider taxes. In most jurisdictions, seller prefers share deals because it's more tax efficient. They make more money post-sale in a share deal than in an asset deal. Why? Well, in a share deal, you're only taxed once. You sell your shares, and then you're taxed based on that sale, typically as capital gains. In an asset deal, it's the company that sells all the assets. So the proceeds go to the company, which is subject to corporate income tax, and then you have to take that money out of the company. You can do it through wages, which is typically very tax inefficient, through dividends, or you can dissolve the company and get it out that way. Either way, you are taxed twice. Once the corporation is taxed on the sale, and then you as the owner is taxed when you get the net proceeds out. Versus in a share deal, you're only taxed once as the owner. Because of this, share deals are almost always more tax efficient for sellers than asset deals. How much taxes you have to pay depends on your country of residence and where your company is based. And because of this, you have to talk to a local tax advisor. And this should be done at least a year before a planned sale because you might learn that in your current setup, a sale wouldn't even make sense because of the overall tax burden, and some restructuring is required prior. The jurisdiction of your company also matters in terms of the chances of getting a share deal. For example, if you own a software business, most of the buyers will be based in the United States, and they will be much more familiar with a US-based entity than one in Germany or Singapore. And therefore, the probability of getting a share deal is significantly higher with a US-based LLC than with another one from another jurisdiction. To summarize, larger transactions are almost always structured as share deals because of the complexity of transferring all the assets. However, in certain niches like software, especially in international transactions, asset deals are very common and often preferred, especially by the buyer. If you want to maximize your chances of getting a share deal, you need to have a neatly structured company in a good jurisdiction with clean financials, no legal troubles, and no other business activities running in that legal entity. Well, this concludes our very high-level primer into asset deals and share deals. This topic gets very complex very quickly, but we hope this overview helped you understand the core of the issue. If you own a software business and consider selling it at some point, and would like to learn more about this topic or anything else related to the sale, you can book an absolutely zero commitment discovery call on our website, where we will be able to answer all the questions you may have. Thank you for watching this video and have a great day.